better your tomorrow with us. See how you can open an account in How We Do It at MyTrade PH. Your path to the best trading experience lies in your hands. Just follow these easy steps and open an account with us. First things first, go to start.mytrade.com.ph to register. Once you're on the landing page, fill out the account registration form and prepare the following requirements for upload. Pause to see the full list that you need to prepare for a smooth sailing process. Make sure that your forms and requirements are complete to guarantee a successful online registration. After you register, you will receive a link with a copy of your submissions. If your registration is a success, you will also receive a notification for an email verification. Patience is a virtue. Just give us no more than 5 business days upon the receipt of your complete documents and requirements for the approval of your registration. Once the complete requirements are received, wait for the email containing the activation of the account and the unique 8-character client code before funding. If you have any question or inquiry, you can reach us on the following channels on your screen. And voila, just like that, the path is clear for a better trading experience with MyTrade PH. Here at MyTrade PH, you are one step ahead at trading. Watch out for our other How We Do It at MyTrade PH, where we make your trading experience easier and better. Good day, everyone, and Happy New Year! My name is Gail Peñaranda, and I am your host for today's Market Outlook. So, how are the first 10 days of the year so far? Kamusta naman yung mga portfolio natin, and how is everyone doing for the past few days and even the past year? Of course, I know the main question for everyone is how is your portfolio? I know everyone is still digesting the heart-stopping ups and downs of 2024, but the air in 2025 is filled with hope and anticipation. What forecasted as an optimistic year, where we expect and look forward to positive movements in the index in the next few months, is going to kick off with PSEI's rebalancing, which most likely will happen in the first week of February, to opportunities hiding in plain sight, even when the index barely squeezed out gains and have endless fights against inflation in 2024. So I can see a lot of comments in our comment section. Sir LB De La Cruz said it was a roller coaster ride for him. The 2024 was a roller coaster ride. Truly, it is. And Ice Cream 03 saying hi sir. Thank you so much for being with us today. And thank you, Sir LB, for being with us even in the live sessions the past few months or years. So everyone, welcome to Abacus Securities Market Outlook 2025, Glass Half Full. To begin our market outlook, we have our first speaker, who also happens to be the first chartered market technician in the Philippines with over 20 plus years of experience in the field of technical analysis. He publishes the Abacus Super Timer. It's the technical research product of Abacus Securities, where he accurately predicted the October 2008 market crash and the market bottom in March 2020, even as the pandemic rages on. Everyone, let's all welcome Sir Lawrence Gonzaga. Hi, Sir Lawrence. Good afternoon.
Hi, good afternoon.
Glad to have you back again on board with us for the first event of Abacus Securities and MyTrade.
Mhm.
Okay, the floor is yours, sir.
Thank you. Yeah, technical market outlook. Okay. Hi, everyone. The PSEI enters 2025 firmly below the 50-day and the 200-day moving average lines, providing a cluster of resistance near the 6,800 level. Let's take a look at the technical analysis of the index, focusing on price action, trends, and some key levels. Looking at the long-term trend, the PSEI has stagnated near the 7,600 level with no sizable price appreciation since the year 2020. When the index peaked at 7,432, there were some attempts above 7,500, and mostly recently we had an attempt slightly above 7,600, but the market quickly reversed lower. A sideways pattern has emerged with support near 5,691, while resistance is near the 7,600 level. Looking at the medium term momentum, the index remains under pressure with upside likely cap at the 6,661 level. This is the recent high, or further up, we have another resistance at 6,800. That's where the 50-day and the 200-day moving average lines were clustered together. On the other hand, looking at the support levels, we see supports coming in at 6337 and 6272. A breakout above 6661 or a break of the 6337 will likely dictate the medium term trend. And focusing on the 50-day moving average line, we can see that it's currently below the 200-day moving average line. So we have a dead cross currently for the market. This signals caution. A golden cross sometime this year could suggest a reversal. So investors should continue to monitor these two moving average lines as well as take into account macroeconomic developments, corporate earnings, as well as foreign activity for Qs. Then, as we mentioned, the PSEI's performance for this year will largely hinge on whether we break out of this consolidation or not. A cautious stance, uh, a cautious selective stance is warranted, but disciplined risk management and close monitoring of key levels are also essential for market participants. Then we go to the daily chart. As we mentioned, the 50-day is currently below the 200-day. So this will exert a downward pressure for the market, or at the very least, cap the upside to between 6,661 or 6,700. 800. And let's go to some individual. Let's go to a screen that we usually run. This is the screen for active stocks that are above the 50-day as well as above the 200-day moving average line. These are the stocks with positive momentum, and as the saying goes, the trend is your friend. So for the big stocks, we have Globe, ICT, Jollibee, China Bank, CNPF, ARIT, Semirara, PNB, as well as DG Plus. Next slide. Next slide. Okay. Here we have Ayala Corporation. We can see that AC will likely meet resistance at the 50-day moving average line, being near the 594 level. And further up, there's strong resistance near 650. So for this, for AC, as long as it stays below the 50-day moving average line, then we will see selling pressure at those levels. Then we have ASEN. The 50-day moving average line is our focus. This is near 420. We have to see if ASEN can muster enough strength to go above 420. Because once it goes above 420, that's the time we will be looking at 440, 450, or even 470 to 480. Then for CRIT, this is one stock that's near its previous high, 310. If we see a breakout above 310, then it will be a new high for CRIT, which will be bullish. Then we have DNL. It's just sideways, but drifting lower with upside cap at the 50-day as well as at the 200-day moving average line. 50-day being at 610. So there's nothing much going on here for the meantime. Then we have GT cap. The current chart pattern doesn't look that good. It's also below the key moving average lines, so there's no need to rush in and buy. And there's a support at 606, which was broken today. Then we have MWC. There's a strong resistance near 2880. Also another one at 30.2. So this is a sell on rally for the meantime. But this is more resilient compared to the other stocks that we've shown earlier. Pure gold. The current chart pattern seems to suggest that further drop is likely with limited upside. The 31 peso level should be a strong resistance. There's another resistance at 29.85. For SM, current chart pattern also doesn't look good. We even have a dead cross, meaning the 50-day cross below the 200-day moving average line. And there's a risk of 870.5 support being broken. Resistance is at 918. PLDT is one of the better looking stocks. At least it's not making new lows. But we have to see it go above the 50-day moving average line. We have resistance at 1343 and 1365. Then we also include some other stocks that clients ask often. One is Bloom. At what price should we buy Bloom? That's the usual question, but trend-wise, there's no upside reversal yet, and there's no support. The last support at 450 was broken, and there's minimal support at 430 or 420, which was also broken today. Then finally, we have Globe. This is one of the more resilient stocks. and investors can look to buy Globe on pullback. We see resistance at 2368 in the near term, then further up 2472. Potential entry levels probably near the 2244 support level. If you compare Globe to the other stocks, most of the other stocks that we've shown, Globe is above the 50-day as well as above the 200-day moving average line. So this stock is enjoying positive medium to long-term momentum. And that concludes my presentation. Thank you.
Thank you so much, Sir Lawrence. That outlook is intact and the forecast is insightful. So I hope everyone was able to get your notes about it. So just a recap, the investable stocks would be Globe, ICT, JFC, CBC, CNPF, AREIT, SEC, PNB, and Plus. So what do you guys think? If you have any questions regarding the technical analysis, you may jot it down below. Feel free to jot them down below in the comment section or later during the Q&A part because we are now heading to the second part of the program. Thank you once again, Sir Lawrence. We'll call you up on stage again during the Q&A.
Sure.
Okay, for the second part of our program, we have our very own head of research. He is the only Filipino recognized by Forbes magazine as one of the Asia's 10 best stock pickers, ranking in the top 5. Who are we talking about? It's none other than Sir Nicky Franco. Hi,
Good
Sir Nicky. Good
afternoon, Bill. Good
afternoon.
afternoon, everyone, and Happy New Year.
Yes, sir. So I think everyone's been looking forward for the outlook today. And there are so many things that we gained during the technical analysis from Sir Lawrence. And now we're moving forward to the fundamental analysis. The stage is
Okay.
yours, Sir Nikki.
Okay, thank you. Okay, again, good afternoon, everyone. The title of our presentation is Glass Half Full. Not sure if you can see the bottom part of the chart. It's dated actually December of 2024. And we, or I, started making presentations to clients in uh, the middle of 20 December 2024, and during that time the mood of the market was really down. It was coming that time was coming from coming off the US elections. Of course, Trump won and markets reacted negatively here in the country and other emerging markets. And so um, negative there was so much negativity at that point, and I really wanted to um, counter at least some of that negativity, and that's why the title of our presentation is Glass Half Full, basically seeing the market in a more positive light than I think most others are looking at it. So let's go to the first slide. Of course, the half empty view. We start with the half empty view, and of course, it all or most of it revolves around Trump 2.0. And this slide shows you where Trump is coming from. Not saying that he's justified in saying what he keeps saying, no. But the deficit with China is definitely large. Same with Mexico, Vietnam, and a few other countries. So the higher tariffs that he plans to impose on a lot of countries um, is going to be negative for markets, especially going to be negative for China and for the region as a whole. This, of course, has led to secondary concerns, specifically on the BPO sector here at home, which will also then have an indirect impact on the property sector. There have also been some fears about the impact on remittances because of the threatened deportation of undocumented immigrants. Um, Negativity also stemming from the unpredictability of Trump and the volatility that he is likely to cause over the next 4 years. And we also want to point out that Fed Chairman Powell's term ends next year. He is most likely to be replaced, and that is going to be a very important juncture for global markets. Uh, there are other concerns, of course, aside from Trump, which led to the negative sentiment towards the latter part of last year, foremost of which was the clash between the top two officials of the land. Also, the glut in both residential and offices have been played up by a number of sectors. The peso, of course, dipping to a new record low, and the third quarter earnings season ended on a sour note. But again, as I mentioned, we prefer to look at the market with a glass half full view. And this begins with China. This slide shows the five key Trump nominees, which we believe will be most important to the Philippines and other emerging markets. As you can see, at least two of these um, incoming officials within the Trump administration have said at least some positive things about the Philippines. And for example, incoming Secretary of State Marco Rubio, who is a former senator, introduced a bill before which proposed strengthening the security partnership between the Philippines and the U.S. On the other hand, incoming Trade Representative Mr. Jameson Greer um, gave written testimony to the U.S. Congress in which he advocated for free trade with several countries, including the Philippines. So it's not all bad for the Philippines, and in fact, there is a chance, I believe, that the Philippines might come out um, even slightly ahead with the incoming Trump administration. Meanwhile, for China, we believe that China is much better prepared this time around compared to Trump 1.0. They've seen what he can do, they've seen how volatile he can be. We think that they're better prepared. Also, global manufacturers are also better prepared. They began diversifying their manufacturing bases away from China during Trump 1.0, and this ramped up during the pandemic. So the global economy is not as dependent on Chinese manufacturing anymore. I think the number one example is Apple. Apple has been producing iPhones in India for about a year or so already, and they've been ramping up production there. And I believe that other global brands have shifted at least some of their production away from China. So we are at least hopeful that this time around, Trump 2.0 will not be as disruptive as Trump 1.0. Moving on to a sector that has been in the news a lot because of the incoming Trump administration. Um, there has been talk about the BPO sector suffering under Trump. It's something of a common view, and it's easy to relate Trump 1.0 to the significant slowdown in both revenue growth and employee growth from 2016 to 2020. This slowdown really coincided with Trump 1.0, but um, Trump was not really the cause of the slowdown from 2016 to 2020. Actually, the slowdown was caused by local issues. For example, during the start of the Duterte administration, they really slowed down the approval process for new PEZA buildings where BPO companies could locate. There was also a lot of uncertainty leading up to the start of 2018 because of the train law. A lot of BPOs, I believe, held off on new investments in the Philippines. They held off on new capacity until they saw the final version of that law. And then lastly, there was a skilled labor shortage in the construction sector, which delayed a lot of projects, both residential and offices. So those were the main causes for the slowdown in the BPO industry from 2016 to 2020, and not Trump. We also want to point out, sorry, this chart shows the previous one um, in a different light, or we present it in a different graphical manner. We can see here that BPO revenues sort of plateaued really from 2016 to 2020. But then you can see from 2021 to 2024, you saw, or we can see a significant acceleration in BPO revenues during this period from 2021 to 2024. And as of last year, BPOs now account for a greater um, volume of foreign exchange earnings compared to remittances. And this really speaks a lot about the resilience and all of the core strengths of the BPO sector. And I believe that pundits have given too little credit to the industry that has continued to grow despite times of past crisis. For example, the COVID crisis, great financial crisis. The BPO sector has continued to grow even despite hard times. And the acceleration that we saw from 2021 to 2024, I believe that a lot of that was caused by US companies that sought to cut costs because of the pandemic. And really, the easiest way for US firms and global firms to cut costs is still to outsource. And the Philippines remains one of the key destinations for outsourcing. Another thing I want to point out about BPOs, despite the huge depreciation in the Indian rupee, India, of course, being our number one competitor in the BPO space, despite this huge depreciation, which should have made Indian BPOs much more attractive because the dollar denominated costs for them have gone down much faster compared to the Philippines. Despite that, the Philippines has remained competitive, very competitive, and as we pointed out, the industry continued to grow. Again, this speaks a lot about the skills and the service levels that Filipino BPO employees provide to clients. So we are confident that BPOs will continue to grow over the next few years, and that is despite AI as well. Speaking of remittances, this is another area of concern as Trump takes his second term. He has promised, of course, to deport all undocumented immigrants. The current number, or the latest number that we saw, estimates that the number of undocumented Filipinos in the US is about 300,000. This figure might be on the low side, especially if Trump follows through on what he said, I think about a month ago. He said that even family members who have legal status in the US might be deported if they are harboring um, an undocumented immigrant. So that number might grow, no? The 300,000 might grow. But even then, this number would still be a small fraction of the Philippines' global diaspora, meaning the remittance, uh, we believe that remittances will remain resilient moving forward. There's also this fact that remittances have continued to grow also despite previous crises, and the only down year really for remittances was in 2020, and that was because of mobility restrictions, not because of any fundamental factor. Meanwhile, what we want to point out is that the Philippine economy is no longer as dependent on remittances as compared to about 10 to 15 years ago. From 2000 to from 2000 to 2024, the CAGR for OFW remittances in peso terms is about 8.7%. This really aligns with the growth in personal consumption expenditure of 8.8% during the same period. However, if we break this down, from 2000 to 2012, the OFW remittances CAGR is 10.7%, and this really led personal consumption expenditure higher. Now, in the last 12 years, from 2012 to 2024, the growth in remittances, the CAGR for OFW remittances in pesos, has fallen significantly to 6.7%. And yet, personal consumption expenditure remains robust at plus 8% CAGR over this period. This means that it's not OFW remittances anymore that is leading uh, or underpinning personal consumption expenditure. In our view, it's really more of lower unemployment and better quality of employment that has driven um, personal expenditure higher over the last 12 years. Moving on to trade, what we want to show here is that ICTSI's volume CAGR or volume growth has been very consistent since 2009. The only down year in this chart was 2009, and that was because of the great financial crisis. But since then, since 2009 and up to what's projected for this year, uh, year in and year out, ICTSI's volumes have grown. So you can see here from 2016 to 2019, that's significant growth despite the trade war between the US and China. And even in 2020, ICTSI's volumes managed to squeak out a little bit of growth despite all of the lockdowns during that year. We also want to point out that ICTSI's volume CAGR since 2008 of 8.1% is more than two times or was more than two times the global average. And I believe that this is a function of the very wide geographical base of ICTSI and the quality of the ports that they have accumulated over the past 2 decades. Moving on to property, even for property, we have a more positive view than most other houses, I believe. What we want to point out for property is this: despite all the negativity, the 9-month earnings growth for the big six property companies, as you can see in this chart, Ali, Megaworld, RLC, SM Prime, Vistaland, and FLI, their combined um, their combined earnings growth for the first 9 months was about 11%, 11.5%. And the PSEI's weighted average for the same period is only about 9.9%, or I think even a little lower. So, in terms of earnings growth, the property sector, at least for the big six, is actually outperforming the broader market. Also, when you see headlines showing how much excess inventory there is, usually what news articles point out or what property consulting companies point out. No? Property consulting companies like Lee Chu, Colliers, Santos Knight, uh, a few others. No, what they usually refer to is Metro Manila. However, Metro Manila only accounts for less than 25% of industry inventories. And the fact is that um, outside of Metro Manila, the property market is at least a little bit better. And it's going to get even better moving forward as the BSP continues to cut rates. Meanwhile, um, property companies have been very proactive. They have slowed down the launch of new projects. They have tightened their standards, and we believe that this will lead to even lower inventory levels moving forward. And with again with falling interest rates, we believe that demand will revive at least somewhat, at least moderately, over the next 12 to 24 months. We also want to point out something in this chart. No? Um, from MegaWorld's 24% increase to VLL's 81% increase, the big six property companies all paid out higher dividends in 2024 compared to 2023. And the average increase in dividend payouts is, I believe, close to 40%. So if there was any sort of cash flow problem, any sort of really concerns or really broad concerns about uh, the property market for the Philippines as a whole, I don't think that we would have seen uh, this kind of change in dividend payouts from these big six property companies. Moving on to monetary policy, we believe that the BSP is going to continue to cut rates beginning in February. I know that there are concerns about the peso, but I think a month or so ago, the BSP signaled at least some tolerance for further peso weakness. Governor Remolona himself, I believe, was quoted as saying that it's possible that the peso will breach 59 is to 1 at some point, and we believe that that will happen over the next few quarters. Um, the concern about the exchange rate, of course, is the impact on inflation, but the inflation impact of the exchange rate has waned over time, meaning um, every peso depreciation for the exchange rate has led to less and less impact on inflation over time. And we believe that the bigger concern for the economic team is the slowdown in growth. We all know that third quarter GDP growth was well below expectations at 5.2%. We're expecting more or less the same for Q4. And as we can see in this chart, real GDP for the Philippines remains well below the 2010 to 2019 trend line. And this is the worst performance among countries in the region. So our base case is that the BSP will cut by 75 to 100 basis points by the third quarter of this year. This just shows inflation expectations, and this shows the historical gap between the BSP's interest rate and the Fed funds rate. And what we want to show is that even if the BSP cuts its rate to 4.75% or 5%, then the gap between the BSP's rate and the Fed funds rate will continue to be respected. It won't fall below the historical low of 75 basis points. With regard to valuations, what we want to say is that the market really can't get much cheaper than what it is right now. The PSEI is close to its widest discount versus its emerging market peers since at least 2006. Uh, 2006 because that's the farthest that Bloomberg data will go back to at present. Uh, Also, the PESEI is at its cheapest ever compared to its regional peers, to its ASEAN peers, based on forward PE. This chart, on the other hand, shows that uh, the PSEI is trading at about two standard deviations below its 10-year mean. And then this chart shows that the PSEI's earnings yield compared to the 10-year yield is, the gap between these two is the highest uh, ever except for the COVID and GFC lows. So again, we see very little downside for the PSEI from a valuation point of view. On liquidity, what we want to say here is that it has improved. Uh, well, this was through the middle part of December, and at that time, the average daily value turnover on a 20-day rolling average was about 5.4 billion. So that was much improved from the low of 1.5 billion in 2023 or at some point in 2023, but it still remains well below pre-pandemic levels. We don't think that this will significantly improve in the near term, but once the BSP is close to reaching its terminal rate, then we believe that at least some um, rotation out of fixed income will happen. And this should be around mid 2025 to the third quarter of 2025. Meanwhile, liquidity is suffering because of the strong dollar. Foreign funds don't really want to invest in emerging markets when the dollar is strong. And of course, crypto has been very bullish over the past few months, again because of Trump's incoming presidency. Um, Bitcoin briefly rising above $100,000. It has corrected a bit, but the mood is still quite positive, and the positivity in crypto is drawing away a lot of retail money from the market. So again, we don't expect a lot of improvement in liquidity in the near term. We also want to point out that there has been increased concentration in the market, which is a negative. The top 15 traded stocks in the market in the past year accounted for about 70% of average daily turnover compared to less than 60% in 2019. The names are mostly the same from 2019 to 2024, but a couple of names dropped out from the most active list, and these are AGI, JGS, and MegaWorld. And in their place have come DigiPlus, AEV, and Globe. So for those who prefer liquidity, these are the 15 names. The on the left hand side, these are the names that you should be looking at. With regard to foreign flows, as I mentioned, foreign funds don't usually want to put money in emerging markets when the dollar is strong. Um, Also, the Philippines is not on the radar for many foreign investors because other emerging markets have better narratives. Among those, of course, Indonesia, India, and Vietnam. Nevertheless, we believe that the waves of foreign selling since 2019 are probably over. As you can see in the left hand side of this chart, the net or cumulative net foreign buying and selling has been relatively or has stabilized a little bit in the right hand side of this chart. Um, Again, we don't think that foreign funds are going to come back anytime soon. But what we want to say is that um, the market doesn't really need foreign funds to come back in order to post a positive return for this year. I think that as long as foreign selling abates, even if they don't come back, I think we're going to have a positive, significantly positive year for 2025. With regard to corporate earnings, as I mentioned earlier, the third quarter earnings season ended on a sour note. So I believe that consensus EPS is a little bit uh, too optimistic. The PSEI EPS CAGR from 2023 to 2026 is 11.8%. We believe that it should be closer to 10% or even 9%. So we're looking for a little bit of downgrades for 2025 and 2026. But even then, even with moderate EPS growth, we believe that um, there is significant room for valuations to improve moving forward, especially with the BSP cutting interest rates. Now, with regard to IPOs, Mint has been in the news quite a bit in the past few weeks or months, and we believe that this is the year that we will finally have one or even two or even three high profile IPOs. So, again, the drought of high profile IPOs may end this year. Um, there was news yesterday, for example, that Mint has already chosen its bankers for its IPO. JP Morgan, Morgan Stanley, and UBS have been picked for the IPO, which may happen in the second half of this year. So there has also been news that the PSE is willing to waive or exempt Mint from the minimum 20% public float for this IPO, given the size of the company. The SEC will have to sign off on that, but it looks like it's going to happen in the second half of this year. This is something I believe that clients should prepare for. We believe that Mint is still in high growth phase, and this is an IPO that we are quite looking forward to. Another company that may come to market is MyNilad. MyNilad has a deadline to go public by 2027, but I believe that they will push through this year because they have significant capex requirements over the next few years. Two smaller IPOs, Okada Manila and Han Resorts, have been talked about, but too we're not too positive that these will happen. Okada Manila's listed owner, Universal Entertainment, recently filed a disclosure saying they expect a full year loss for Okada Manila. So I don't think that they will push through with an IPO coming off a year where they uh, posted a loss. Then Han Resorts is a relative unknown, and it will compete for money with Maynilad and Mint. So it may not have a market. Meanwhile, SM REIT, I think there's a small chance that it will push through this year, simply because the best time for a REIT to launch is when the BSP has reached its terminal rate. And again, we expect that to happen in the third quarter of this year. So moving on to uh, how we arrived at our top picks for this year. So we employed several equity screens. One of this is with regard to liquidity. We looked for companies that um, showed improved liquidity compared to 2019, but that would leave us with too few companies. So we also considered stocks that were able to at least retain 70% of their liquidity compared to 2019 levels. We also looked for deep value, meaning companies with forward PE ratios that are 1.5 standard deviations or more from their long term mean. We also looked for companies or stocks that have a moderate to high negative correlation with the BSP's RRP rate. And then lastly, we look for companies with EPS growth of at least 10% for both 2024 and 2025. So just to recap that, I'm sorry, there's some names that got blacked out. I think I think the PDF glitched. But in any case, this table summarizes our thought process, summarizes our equity screens. It also shows that we employed qualitative screens. No? And some names have an X on their qualitative. For example, Meralco. Meralco, we're concerned about the rate reset, which the ERC promised to happen within the first half of this year. We believe that there's significant uh, probability that Meralco's distribution rate will go down significantly. RLC has an X because of that sales cancellation issue a few months back. But in any case, the ones highlighted in gold are the ones that are included in our topics. These are AC, Manila Water, Pure Gold, SM Prime, and PLDT. And then we also added ASEN, GT Cap, CREET, and DNL. Um, in these in for these names fall under at least one sector that we favor. We also want to point out that these 10 stocks have little or zero risk tied to China. These 10 stocks are also leveraged to lower interest rates via the property sector, via lower interest rates on debt, or the likelihood of increased demand because of lower interest rates. And then lastly, as a portfolio, these 10 stocks will not suffer significantly because of any forex gyrations. So the impact on their financials should be relatively benign, even if the exchange rate becomes volatile over the next 12 months. So to summarize, the current mood of the market is still negative. The half empty perspective really is prevailing, and this paradigm is going to be hard to shift. However, we hope that we were able to show that concerns about Trump 2.0 are largely overblown, and this is with regard to China, remittances, and outsourcing. So, again, our view is half full, primarily because equities are quite cheap, especially with regard to bonds, and there's little downside from a valuation point of view. We believe that even with moderate EPS growth, multiples can expand to 11 to 12 times earnings. And with that, our fair value for the market, for the PSEI at by the end of 2025 is about 8,500. Now, this is fair value. We're not saying that this is our target for 2025. I believe that a more realistic target for the PSEI this year would be about 7,700 to 7,800, which would be about 11 times forward earnings. So going to our key recommendations, this still flows from the title of our presentation 6 months ago. Just keep buying. And again, this is because Philippine equities are cheap, both on absolute and relative basis. I believe that 5 to 10 years from now, most will wonder why they didn't buy. So we are overweight on consumer discretionary, telecoms, REITs, renewables, and conglomerates. We are underweight on consumer staples, legacy energy, and construction. We are neutral on the rest. Our top trade is with regard to the PSEI rebalancing. We believe that CBC and AREIT will be added to the index in place of nickel and Wilcon. We have a conditional buy on JGS uh, if and only if it sells or reduces its exposure to the petrochem business. Now, we are positive on Monde, but we would be more aggressive in buying Monde if the company reduces or sells its exposure in the meat alternative business. And then lastly, keep some dry powder for IPOs in the latter part of 2025. So that's it for my presentation. I think we shall go to the Q&A.
Thank you so much for an extensive outlook, Sir Nicky. Please stay on stage because we are going to do the Q&A right after. And I just say that I love how it is tied up to our mid-year outlook last year, which is just keep buying. So everyone is, I know, hopeful that in 5 to 10 years time, just like what you've said, everything will go and push through. So I'm sure all of our viewers right now are writing down their summaries and noting down strategies that they have picked up from you and Sir Lawrence, from the half empty views to the stock picks that will most likely replicate the yields from last year. I know, and I can feel from the comment section that everyone feels the excitement and gains confidence for the next half of the year. You were saying it was quite negative to think of it as half empty, and our view is half full. So I really love that part, Sir Nicky. Um, okay, so now that we have the outlook and insights, I'm sure all of you have a lot of questions in mind. And to help me moderate the much awaited part of the program, let's all welcome back on stage Sir Lawrence and our Abacus Securities investment analyst, Rainier Yu.
Hello, good afternoon, everyone.
Hi, Rainier. How are you? Happy New Year.
Happy New Year, everyone. I hope everyone was able to appreciate the insights and commentaries for the Philippine macro and as well as the stock market. And I think we're ready to kick things off. Uh, well, I think there were some questions that were sent ahead of time. So
Yep.
I think we can begin with that's one of the hotter stocks lately. So one of the viewers, Kevin, is asking for a funda take and as well as a technical outlook or analysis for Dito.
Um, let me. So I'll start off on the fundamental side. Um, Actually, we haven't really taken a close look on Ditto in the last maybe 6 months or so, and this is because the company is still relatively far from achieving break even, and the goalposts appear to be moving. Um, I can't recall the exact number, but currently the um, the number of subscribers needed to reach profitability, I believe, is 20 to 25 million. And that has grown significantly compared to previous estimates. Um, and it seems that it's going to still take quite some time before they reach that number. So we're not, on the fundamental side, we're not really too keen on Ditto at the moment. Of course, the technical side might be different. So I'll give the floor to Lawrence.
On the technical side, there seems to be resistance close to the 230 level. If Dito cannot break 230, then there's risk that the stock might fall back, and if it breaks 196 on the way down, or even 194, which is the 10-day moving average line, then we could see further correction back to around 169, 170 level. So at this point, it's hard to say. Most likely, the stock will consolidate and try to hold above 196. But if it breaks 196, then we could see lower levels for Dito. The main concern here is, I agree with Nicky, no? how how much the company is burning through its cash every month, and how much cash the company has. That's always something nagging in my mind about this stock. Yan.
Okay, thank you for the insights, Sir Nicky and Sir Lawrence. And I think Dito over the past trading days has been one of the top movers. The top most active stocks, and it bears repeating the words from Sir Lawrence and Sir Nicky that we should remain cautious given the volatility behind the stock. So I think we can move on, and I just want to take this question ahead of the others because I think this is one of the topics that have surrounded the headlines as well, and maybe uh, our mentors here can provide some insights as well. So, question here is the Philippines is boosting the tourism. So, on that note, is Seb a good pick for the long term? So, mentioned this because I think just earlier this week, the Department of Tourism has announced that tourist arrivals came in at 6 million, which is below its initial target of 7.7 million, and even slightly below its adjusted target of 6 million.
Okay. There are um, several things that need to be pointed out now with regard to tourism. The first thing is that um, the number of tourists last year, which is about 6 million, was well below projections and well below 2019 levels. But it's worth noting that the number of tourists from maybe 2017 to 2019 was bloated by the number of POGO workers who were going in and out of the country during that period. So I think that the volume of tourists from 2017 to 2019 was bloated, and um, it's impossible to comb through the numbers. No? But I think that the tourism industry is actually doing better than what it appears to be. The other point is that um, the the infrastructure is not really there yet, not in the near term, but it will be there specifically once San Miguel is able to finish the Bulacan airport. And I think everyone is hoping and praying that that facility comes online sooner rather than later. But I think it's more realistic to expect that siguro 2028 or 2029 or even later pa. So to answer the question really, yes, Cebu is a good, very good actually, a very good pick for the long term. It is at the forefront of the tourism industry. Um, it will be among the biggest gainers once the Bulacan Airport is open. We also want to point out that despite the crisis, despite not getting any support from the government during the pandemic, Cebu Pacific is actually the one that has been able to increase capacity over the past year or so, whereas Philippine Airlines and Air Asia, their capacity has been relatively stagnant. And that's why Cebu Pacific received 17 planes last year, 17 or 18 planes last year. And the number of seats that they're going to offer this year is 25% higher compared to 2024. So the numbers are going to be there for Cebu Pacific, um, not just in the long term, but even in the near term.
Sir Nicky, I have a follow-up question on that because with the updates that we've been getting the past few short takes, I saw that we noted that the volume of tourism or the visitors coming in the Philippines is almost double from the pre-pandemic days. Of course, number one reason for that is the revenge travel that they're calling. So people are coming in and out of the country to travel because they were down for like 2 to 3 years because of the
Mhm.
pandemic. So now that we are coming in at, we just came in at 2025, do you think that will ramp up given that we will have a new airport in Bulacan?
That will definitely ramp up now. But again, as I mentioned, that won't happen until probably 2029
Yeah.
or even later.
Mhm.
The fact is, Manila International Airport is simply operating well above its designed capacity. And it's
Mm,
actually a miracle that the numbers there continue to grow despite that. No?
yeah.
Uh, but then uh, we see Clark growing 20% in terms of passenger volume last year. So
Mhm.
Clark is becoming a bigger hub.
Yep.
Maybe it can support tourism in the country, but we really need the San Miguel's. We really need San Miguel's Bulacan Airport to really grow the tourism sector.
Okay. Let's. I hope that answers your question, Tayo Lowe's. Maybe we can move on to the next question, Rainier.
Yes. So I think we've taken a look at that sector, and maybe we can take a look at another one. More on the property sector, as Ice Cream has a question here. RLC's earnings growth looks good, but share price continues to come down. Is this an opportunity to buy, or should we just avoid the property sector because of the sentiments that we have now?
Um, for RLC, kasi it's the issue with RLC is very company specific. As I mentioned earlier, uh, the sales cancellation that they recognized in the third quarter, amounting to 8 billion, really hurt the reputation of the stock. Um, it was completely unexpected. And again, that really hurt the uh, sentiment for the stock. And that trickled to the rest of the property sector. Um, so specifically for RLC, I don't think now is the right time to buy because it will take quite a bit of um, time for RLC to regain its reputation among investors. They will have to work hard to reassure investors that this is something that won't happen again. Um, but with regard to the broader market, I think that this is indeed an opportunity. Specifically, we're looking at SM Prime. Um, and for SM Prime, it's not really the residential side, it's not really the office side. But we're a buy on SM Prime because of its small business. Um, we are positive on the consumer discretionary space. However, URC has its issues, and we believe that Jollibee is closer to fair value. And so our view is that the best platform to capture the growth in discretionary consumer spending is through the mall owners and specifically SM Prime. So um, we are again, we're more positive on the property sector compared to our peers. Um, SM Prime is our top pick, but even Ayala Land, Mega World, and the others will benefit from lower interest rates moving forward.
Okay, thank you for that. I hope that clarifies your question, Ice Cream. And I think we can move forward to some of the more pressing issues that we are seeing today on the individual stocks. And I think this is a fair question to what we're seeing today, since we mentioned of our trade ideas on A-REIT and China Bank. Since prices have been going up, is it still okay to buy today? Are still more upside? And is it not too late to add position today? So I think we can start off with Sir Nicky, then Sir Lawrence can provide some technical insights as well.
Um, for CBC, despite the run up on a fundamental basis, it's still quite cheap. I believe, if I'm not mistaken, it's only about 6 times or 7 times forward earnings. However, the run up has really um, made it vulnerable to a significant correction after the announcement, after the PSEI rebalancing announcement. So for me, I probably wouldn't chase China Bank. I would hope that it comes down a little bit. In the past few months, it has done that. No? It has sometimes it pulls back quite a bit, and I would wait for such opportunities to get into the stock. On A-REIT, it has gone up, but not as much as CBC. So this is a stock that probably I would tend to buy more of for the PSEI rebalancing. You are also relatively protected on the downside because, again, interest rates are going to come down, and that should benefit REITs in general. A-REIT also pays out quarterly dividends, so that should um, help protect your downside as well. So I would be more partial to A-REIT. But even then, I think it's better to wait for pullbacks on A-REIT.
Okay, I hope that answers your question, Nash Organics. A-REIT over CBC, and um, just hold on tight. Let's move on to the question. Next question, Rainier.
Sorry, I think we can provide some
Yeah,
technical
so,
insights
yeah,
for
technical
A-REIT
analysis.
and
Yes.
CBC.
Of around 74, while support would be near 67. I look for pullbacks to buy CBC. As for ARIT broke out today above the 40 peso level. This is significant. This is the first time that it has gone above 40 in quite some time. And we see potential upside of around 45 or even 47, 48.
Okay, thank you for that, Sir Lawrence. I think that adds to what Sir Nicky mentioned. And on the opposite side of the PSEI rebalancing, I think we have some questions on Nickel Asia and what will happen or what's the outlook probably, especially once after it is deleted.
Um, I think I mentioned in short takes today, no. Um, Nickel is not the company that we would look to buy even after it declines more once it is booted out of the index. And this is because the price of nickel metal is near multi-year lows. It's actually near the pandemic low already, and the outlook is still quite negative, particularly because of the weak property sector in China, the weak economy of China as a whole, and also because the electric vehicle industry has slowed down significantly. There was a lot of, I think there was too much hype about the electric vehicle industry, and there has been some pushback, or there has been some um, doubts about doubts from consumers about buying electric vehicles, and so the growth has not materialized as much as they thought it would. The outlook is still very positive over the long term, but the growth path is probably going to be much less steeper than previously expected. So again, the price of nickel might continue to go down. I don't think that the price of the metal has bottomed out. Um, I don't think that you. I don't think that we should be bottom fishing on nickel. I would rather bottom fish on Wilcon rather than Nickel Asia.
Okay, thank you for that, Sir Nicky. Maybe some technical insight as well for Nickel.
There's the next support of nickel at 292. After that, that would be below 259, 230 plus.
Okay. Okay, thank you for that. And then for nickel as well, we do have a strategy for both nickel and Wilcon, and it is published in our short takes today. So for our viewers who are not yet subscribers of MyTrade, please do create an account with us so you are able to get exclusive reports from us, basically. So next question. So uh, there is that recent disclosure from CREC. So what can you say about the recent investment of a foreign firm or Indonesian firm to CREC, and also a technical insight for CREC as well?
Um, I only saw a snippet of the disclosure because we were preparing for this event. But generally speaking, when you see a company of the stature that CREC got to invest in the company, then that is definitely a positive. It validates the strategy of CREC's management. It removes a lot of execution risk and financial risk for CREC, and we have become more confident that the company's vision of adding up to 1,000 megawatts of renewable capacity every year. We have more confidence that they will be able um, to do that over the next few years. So it's really again a validation of the investment thesis for CREC.
Okay,
Yeah.
thank you, Sir Nicky, Sir Lawrence.
On the chart, it's a breakout with projected target of 360 initially, but it can still go even higher. So the recent movement is bullish.
Okay, thank you. And just for everyone's information, the disclosure today was a investment to CREC from an Indonesian firm, a state-owned Indonesian firm, and the price of that transaction is valued at 3 pesos of unissued CREC shares. Then moving on, I think there's a follow up basically on the new renewable space, thoughts on the RE space and power sector, and with issues on SPNEC, AP, and SGP.
Okay. As I mentioned, one of our um, top sectors is the renewable energy sector. The Philippines is, I believe the government is really serious about the ongoing energy transition, no? Or at least a transition to a more sustainable energy infrastructure for the Philippines. And this really involves a lot of investments in solar, wind, battery energy storage. And companies like Espinec, CREC are at the forefront of that. Of course, legacy energy companies like Aboitiz Power, San Miguel, Meralco are also going into renewables, and that speaks a lot about the um, the viability really of both solar and wind moving forward. Now, on a company specific basis, for Espinec, um, I believe that Espinec is going to be a play for the second half of this year, going into 2026. The Terra Solar project is, management says at least that the Terra Solar project is um, still following its timetable, meaning they expect first energy production in February of next year. So as the company gets closer and closer to completing that, I believe that the share price will eventually reflect that. On Aboitiz Power, we also wrote about Aboitiz Power in our note for today. The company has about 800 megawatts of renewable energy capacity that they have either recently energized or are about to energize over the next 12 months. However, the impact on the company's total production is going to be relatively small, maybe 5%, definitely within the single digit level. So we're not too keen on Aboitiz Power. And actually, we called a switch from AP to Aboitiz Equity today. So we would rather own AEV rather than AP. And then on SGP, I think there's a lot of risk with regard to SGP. Um, Congressman Salceda, for example, saying that the maximum allowable revenue for SGP was about 200 billion pesos lower than the revenues that they recognized from 2016 to 2020, if I'm not mistaken. So he is advocating for a mechanism that would um, force SGP to um, pay back those excess revenues to consumers. So um, and the ERC, as with Meralco, the ERC is also in the midst of finalizing the rate reset process for SGP. And if Salceda is correct that the weighted average cost of capital for SGP should fall from 15% to 10%, which is something that we agree with. If he is correct, then that's going to significantly erode the profitability of SGP. So I would not be touching SGP at the moment.
Thank you, Sir Nicky, for the insights on the power sector. I think we can move on to another sector that is much more volatile, to say the least. And just to say that it's nice to see our viewers are engaging more to the more active and more liquid stocks. And this one question from Shalant: are we expecting DigiPlus to reach 50 pesos within 5 years?
Um, what I'm fond of saying is that it's actually hard to forecast even 1 to 2 years ahead. So, uh, trying to forecast 5 years, 4 or 5 years from now, it's um, very, very difficult to say the least. Um, I guess if DigiPlus really is able to execute on its strategy, both here and in Brazil, then 50 is um, something that something that might be within reach, no, but it's really impossible to say at this point. um, I know that there is a lot of hype and a lot of hope attached to the recent announcement that they already got final approval for operations in Brazil. But we want to emphasize that DigiPlus won't start operations in Brazil until the fourth quarter of this year. And the first platform that they're going to introduce is the sports betting platform Arena Plus. And if you've been reading our reports, you will know that Arena Plus is the smallest contributor to the earnings of the company. Um, Now, sports betting is much, much bigger in Brazil. By some estimates, the the betting market sports betting market will grow to about 10 billion to 11 billion dollars worth of gross gaming revenues by 2029 or 2030. So even a little bit of percentage of that should be significant for DigiPlus on the revenue side. However, we do have some concerns, or we have a lot of concerns about how much they need to spend to get significant enough market share in Brazil to gain traction. So I think that's the biggest question mark for DigiPlus. And for me, nothing is assured, especially since DigiPlus is going to go up against the biggest names in the sports betting industry in Brazil. They're going to go up against giants like DraftKings, what's this, Flutter Entertainment, Bet365. All the giants, or most of the giants, are going into Brazil specifically for the sports betting. So it's going to be a very tough market to crack for DigiPlus. I don't think that it's right to um, put too much hope or to put too much emphasis on Brazil at this point, because again, operations won't start until fourth quarter of this year, and so we probably won't see anything significant from the Brazil side of the operations until the second half of 2026 at the earliest. So I think the share price should correct a little bit more, and we would look to come in at lower levels for DigiPlus.
Thank you for
Rainier,
that. Yeah.
just want to ask us, it's quite blurry still to look at it in a 5 year view. Maybe we can take a look at the technical analysis part of Digiplan so that Shalan will be able to take a look at the resistance and the support levels. Sir Lauren?
I will just touch on the immediate outlook
Mm.
because it's really hard to project 5 years ahead.
Mhm.
For the resistance, there's one at 2960. That's the resistance. If we break 2960, then we can expect DG Plus to continue going higher. Currently, there's not much pattern to support any price projections yet. Maybe we will see a clearer picture a few weeks from now. On the other hand, we have support currently at 2550, but if we break if plus breaks 2550, there should be strong support coming in near 24 pesos. So long term, plus still looks okay. Probably look to buy on pullback. If ever it will reach 50, I don't think you need 5 years, probably 2 years.
Okay.
Okay. Thank you
I
for
hope
that.
that helps, Shalant.
And there is a follow-up question. So this is also a relevant question. Is there a possibility that Plus will be included in the index by their next rebalancing in mid-2025 or in August? Blue market cap currently at 48 billion is lower na as of the moment. Plus currently is at 120 billion.
Um, it's not as simple kasi as looking at the full market cap. There are other parameters that the PSE looks at, um, and what one of the things that should be compared is not the full market cap but the VWAP market cap, meaning if you're looking, for example, at the mid 2025 rebalancing, then you should compare the VWAP market cap of Plus uh, at that time with the others in the market. So the VWAP market cap is the total number of shares outstanding multiplied by the VWAP of Plus from July 2024 up to June 30, 2025. So it's a little bit too early to see if Plus has or will be able to join the index. But I was looking at it just the other day. Um, for me, I don't think that there will be any index changes in mid 2025 kasi unless something really moves very quickly and very significantly over the next 6 months. So for me, right now, I don't think there will be any index changes in mid 2025.
Okay, thank you for that, Sir Nicky. And I think we can move on to another issue on OGP, since gold continues to track ahead of the highs, and potentially what is the impact to OGP?
Okay, on OGP, I'll probably say two things. First, um, the company, about a year ago, the company decided to revise its mining plan. And what happened with that is that um, it resulted in much lower ore grades than what they had expected at the time of the IPO. Um, at the end of the third quarter, the changes to the mining plan had not yet been implemented. So the fourth quarter is likely to remain weak. And then the second thing I'd like to say is with regard to the dividend. Now, the the dividend for the second quarter and the third quarter were quite generous when you look at it from a yield point of view, or from a payout point of view. But how, but that is because the government's share will only be paid out at the end of the year. So and they pay out dividends on a quarterly basis based on free cash flows. And so the free cash flows for the second quarter and the third quarter were bloated because they weren't paying yet the government share. And the government share likely to be paid out in the fourth quarter. And I believe there's a significant chance that the dividend payout coming from fourth quarter earnings is going to be very small. So I would not be buying OGP at this point, especially since there's still little visibility on when they will be able to finish the revised mining plan.
Okay, thank you for that. Maybe Sir Lawrence, maybe some insights on whether OGP, where OGP stands at this point.
Currently, the chart picture is actually not too bad. If OGP can break a recent high of 1470, then we can probably see further rally to around 15 or 1550 or even 16. The trend is turning positive. Yan. But just because of the recent high,
So right, I think we are, or Sir Lawrence is experiencing some technical problems. And since we are close to wrapping up, and it's already time, maybe we can have one last question. Right,
Mhm.
Gail?
Yes. Let's move on to the last question. So don't worry for all the other questions that we were not able to answer. We will answer it on the comment section in the next few days. So for the last question, Rainier.
Yes, I think we can close with this since this is part of our top picks this year. So, what's your view if solar panels, aside from land, will be infused to C-REIT? And what would be a good ratio of solar panel to land to keep CREIT or C-REIT attractive?
Mm. Sorry, this is the first time, honestly, this is the first time I've heard of solar panels being infused into a REIT or specifically to CREIT. As far as I know, management has not brought it up. I think that I think that what they are doing is just concentrating on the land portion. No? Uh, so I don't think that this. I think it's feasible. I don't see any problem with it because it's a fixed asset like land. So theoretically, I think it's possible. But simply because management has not brought it up, I don't think it's a priority, or I don't think it's in their plans. But theoretically speaking, to answer the question of what would be a good ratio of solar panels to land, um, the rule of thumb is that 1 hectare of land um, will support about 1 megawatt of solar capacity. Um, with with solar technology today, that might that ratio might go up, no? Meaning might go up to 1.1 or 1.2 megawatts for every 1 hectare of land because solar panels are becoming more efficient. So that's as specific as I could possibly get. No, probably 1.1 to 1.2 megawatts worth of solar panels for every hectare of land.
Okay. I think we can, Gail, sorry, I think we can wrap up. Thank you
Mhm.
for the last question, Mokong Boy.
Yep. And also to Mokong Boy, you might want to check out the podcast with Sirek. With a little bit of Sirit, a touch of Sirit. So we did that with them last year. They might have talk about with the in relation to your question. They might have a bit of an answer there. So just look at it in Spotify, our podcast, My Trade Unplugged. So you'll be able to understand better where Sirek and Sirit is are heading to. Okay, I think yeah, that's it for today. For our market outlook. Thank you so much, Sir Lawrence and Sir Nicky, for being with us today. I hope everyone was able to um, jot down all the details that all the strategies that we will be having in the next few months. So we are equipped and we are ready, hopefully, with all the details and all the information we got today for the market. And thank you also, Rainier, for being with us today to moderate all our questions. And we're now heading to the next part of our program. Thank you once again, Sir Lawrence, Sir Nikki, and Rainier.
Okay, thank you.
All right, now we are all excited for this last part of our program. We've been doing this in the past events, and I'm sure all of you know what is about to happen. Let's bring out the roulette. We will be giving away 10 packages to 10 winners who signed up with us the past few days and the past few weeks. So the first winner will get MyTrade merchandise, which are 2025 calendar, notebook and pen, and mobile stand. All right, who's our first winner? Let's see, there's so many people who signed up with us. Who will be the lucky 10 winners? Number one is Miss Rosaline Banga. Screenshot this, Miss Rosaline. If you are already a client, please send your client. Please do send us a private message so we can get all your details. Next winner for the second one, Mr. Roland Go. Congratulations. Don't forget to screenshot your name on the screen and send us a message with your client code if you're already a client. Moving on to the third winner. Who will be the lucky winners today? Let's see. All right, third winner is Miss Gladys Maripet Yusinko. Congratulations, Miss Gladys. Don't forget to screenshot this and send us a message. And if you're not yet a MyTrade client, this is probably a start for you. Don't forget to just click on start.mytrade.com.ph to send us out your application form and to open an account. Next winner, our fourth winner. Let's see who is the next winner. Sir Jeff Chua, congratulations, Sir Jeff. Please screenshot, send us a message together with your client code, or if not, send us your details, name, address, and contact number. All right, let's move on to our fifth. Am I right? Fifth winner? So you'll be getting an exclusive MyTrade merchandise, which are calendar, notebook and pen, and mobile stand. Congratulations, Miss Eleazar Gayon. Please screenshot and send us a message. All right, down to our last 3 winners for today. Next is Sir Roger Relucio. Congratulations, Sir Roger, for winning today. What a great start of the year. You'll have MyTrade merch to equip you in all your strategies and in positioning your portfolios for the year 2025. Next, down to our last 2 winners for this year's market outlook. We have Miss Helen Chua. Congratulations, Miss Helen. Please screenshot. Don't forget to send us a message with your client code or with your customer information, name, address, and contact number. And we'll be sending these merch to you right at your doorstep. Now we are down to our last winner for this year. Let's have a roll of the names. Let's see, the last winner is none other than Sir Carl Fernanpua. Congratulations, Sir Carl, for winning our MyTrade PH merch for 2025. Now, screenshot, send us a message with your client code, or if you're not yet a client, do send us your name, address, and contact number. Thank you all so much for tuning in with us today. Don't worry, you still have a lot of chances to win our MyTrade merch because we'll be having our bi-weekly live session, which is Beyond Connections. So stay tuned. We'll be giving out some of these items in the next event of MyTrade PH. And don't forget to start a better tomorrow with us when you open an account at www.start.mytrade.com.ph, or just shoot us a message on our social media channels, and our customer service team will be providing all the help they can to you. And don't forget to follow, like, and subscribe to MyTrade PH for the latest news and stock market updates. Once again, this has been Gail Peñaranda. See you again in our next market mid-year outlook in the mid-year this 2025. Happy trading, everyone. Bye.